Thank you very much, Steve, for the introduction, and as well, Onchain, for giving us the opportunity to share our story, especially in these crazy, hectic times. Having a virtual meetup is something that is extremely helpful, and is really great to connect over. So I think, again, thank you very much, everybody, for joining. My name is Steph. I'm part of the Keyrock team. I've been active in the digital markets for the last 4 years and a half, mainly on the secondary markets as a service provider. I think for us, the goal of today is to share as much knowledge as possible. And we are here joined today by Kevin and Alex, both CEOs of the two different companies, which is a great opportunity to not only share some insights on our companies, to get into the nitty-gritty of market making, liquidity provision, and custody solutions, but really having also an overall discussion on market trends, where we see the opportunities in the future, and really use this as an opportunity to share knowledge and not just talk about our companies, how great we are. I think that was that's not the ultimate goal of today's call. So without further ado, welcome Alex and welcome Kevin. Again, thank you very much for joining on this call. I'll maybe give a short introduction. I'm going to just read your bios, and then we can really dive into the experience itself. So Alex, CEO of Onchain Custodian, has more than 20 years of experience in the capital markets industry, from global custody and asset servicing at the Bank of New York to data standardization and security Asia Pacific at Swift. Welcome. Then Kevin, as a co-founder and CEO of Keyrock and my colleague, Kevin started his career in private banking and moved to strategic consulting within Roland Berger, covering topics from financial services to private equity. And in 2014, he initiated the development of the Global Blockchain Competence Center, which is definitely something we'll be covering today. And really that time gave him all of the inspiration and also the connection with Juan David Mendieta and Jeremy Degroot, two other co-founders, to start Keyrock. So maybe Alex, especially with your background in Swift, you've made a very exciting jump from traditional finance to right now the very exciting digital asset space we're operating in. Swift as a major global player, which was extremely relevant, at least extremely relevant still. And also for our industry is something that is very interesting. So maybe can you share some more insights on your experience and also how this helped you with Onchain Custodian?
Sure. So good afternoon, good morning, everybody, depending where you sit in the world. Effectively, I started my career as a clerk in custody operations in Brussels at the Bank of New York, and kind of like it actually, managing assets of others and making sure that they are safely transferred to counterparties, managing reconciliation, breaks, claims, corporate actions. So quickly at that time, I started learning about everything about capital markets as well as securities, and I took that expertise to Swift, where I've been working in the standards department for most of my career there, building processes, market practices around operations in the custody space. So it was a natural step for me when I was approached by Da Hongfei, the main founder of the company, to run a new business he wanted to launch in Singapore. It was a natural step for me to leave this career and try something new. I had been in touch with blockchain and digital assets at Swift, participating to proof of concept, at least designing the theory behind those proof of concept and trying to launch some of them, trying to advance the agenda internally at Swift. And I said, well, why not? I'm 46 years old. If I don't do that now, I will never do it. And I just seized the opportunity, and with El Lee and Raymond Chong and Da Hongfei and all the team, we've been building Onchain Custodian since. That was in November 2018.
Great. What I think is that not only is your traditional background extremely relevant, but also being supported by people like Da Hongfei is something that's pretty unique. Interesting about Da Hongfei, when he started the N-Shares in 2014, at the time, Kevin was working on his blockchain initiative at Roland Berger. So great timing. At the time, I remember that N-Shares and NEO was still called the Chinese Ethereum. think that was not something that they deserved, but still great timing. Maybe Kevin, you're currently leading a team of 25 people in algorithmic market making. The shift from Roland Berger and then talk about blockchain and now really working in financial markets in a new digital asset space is quite a shift. So maybe it would be great to have some more insights on there as well.
Sure, I'd love to. Thanks, Steph, for the intro. Thank you, of course, Alex, and the entire Onchain team for hosting this webinar today. I think it's a great initiative. So indeed, the switch from Roland Berger to digital asset market making is a bit maybe a bit unusual. So I started working on Roland Berger in some management consulting in 2014, and quite quickly actually focused on financial services and private equity. And it's around that time that I started to be interested into Bitcoin. As many people, I think around these days, the price was going insane, and at some point just draws your attention. So I started to look into Bitcoin, what it was, what it meant, what blockchain actually was. And that's what got me involved in the technology in a decentralized ledger. And basically, I decided to drive Roland Berger to be more and more interested into it. So we basically launched the Global Competence Center, which is a very fancy title for publishing papers at the beginning, because there was not much done by incumbent financial services player. Not much was done around blockchain in 2015. So basically, it was a lot kind of trying to establish thought leadership and explain to our clients what could be done, and what disruptive potential that technology actually held. And that's what really got me more and more interested and pushed me down the rabbit hole, I would say. And what I realized after a couple of years exploring the field is really that the one mainstream application was the use of blockchain in basically a new type of capital market, and that's really when I started to think about more about what the technology held as potential for capital markets, how it could help, what added value it would have. And it's around that time that I met Juan David, Jeremy, and we realized that liquidity was something that was effectively, of course, key for any type of market, for any type of financial market, was one of the main added value of digital assets, for the potential liquidity, and also a key issue in the market that is really decentralized. And so that's when we kind of started to focus and laser in on solving liquidity issues in the market, and got us to launch Keyrock. That was, I think, it was end of 2017 that we got started, and we've been building the company and the service to the market ever since.
Awesome. I think what would be really great if today, and also, by the way, to all the attendees, we really welcome all interaction. So what we'll do after this session is, I think after about 35 to 40 minutes, we'll have an extensive Q&A. So please post your questions in the chat. We will be answering them afterwards in a really, as hopefully as many questions as possible through that time. So please post in the chat and we'll cover them afterwards. And talk about questions, I think, what I noticed with a lot of the conversations that we're having, and I'm sure it's the same with Alex and the team, is that the concept of custody or the concept of liquidity is sometimes misperceived. People do tend to have their own definition for this specific concept, and we'll dive a bit deeper into it later when we talk about liquidity, but also on the custody side of things. Alex, through our conversations the last year and a half, I feel I've learned a lot of things, and I think a lot of people still think it's normal for a centralized exchange to hold custody of their assets, which is something that is unthinkable in the traditional markets. At the same time, it's not as simple as just a custodian and exchange. There's a multitude of different little steps in that whole process, and it's something that we were still also amazed by when we talked with you. So I think it will be very interesting for the audience to also learn a bit more on that side. So we know that it's not just a very simple process where you just hold assets, but that the whole ecosystem of custody is something that is not underestimated and quite complex sometimes.
Sure. So let's talk about custody first, and the reason why third-party custody makes sense in this industry. So the promise of decentralization and blockchain is obviously that every user on this planet can hold himself, its assets on his Ledger Nano S or on a wallet somewhere. The reality is that it's not that simple to do. It might be for the geeks of our industry who love to manage private keys themselves and deal with that on their own, but it's not necessarily the case for new players in our industry, or even players that believe they can do so properly and prove month after month that they're not able or capable or focused enough to do that properly. I'm referring to exchanges who are hacked on a regular basis because it's not their core focus. Their core focus is to intermediate buyers and sellers, offer liquidity to the market through market makers and other solutions. It's really not, and you can see that by the amount of money that they invest in custody, that it's really not about custody. So that's why there was a surge of demand for third-party independent custodians in the recent years. That was initially filled by US-based custodians and more Asia-Pacific-based custodians to cover regional needs and regional way of doing business, just for the simple fact of holding assets in a secure environment, enterprise grade, professionalized, with the right operational infrastructure in place, the right business continuity plan, for example, in today's situation, for example, the right BCP plan in place to ensure that these assets are always safe, always accessible, and insured by insurance premiums, which is something that exchange never managed to do. So the idea is to let's try to replicate from the traditional capital markets industry what makes sense, which is segregation of duties between trading and custody. Let's try to make it professional in a sense that it's not only benefiting exchanges who would want to outsource that custody to a third-party custodian like us, but it's also about making sure that asset managers, family offices, high net worth individuals, and even individuals who don't want to manage private keys and wants to have a single window access to all their coins, all their holdings, that they can do so using service providers like Onchain Custodian. So that's the custody layer. And on top of the custody layer, what we are building is what we call open finance services, which enable our customers to deploy their assets into services like lending services, asset management services, or other type of investment opportunities. That's something we build with partners because we believe that we are very good at custody, but we are not the expert into wealth management. We're not the experts in lending, and we want to trust people who are focused on those type of activities to do that for our customers.
Before the session, we got quite a few questions on liquidity. Liquidity is a word that is often used and often misinterpreted. If you look at how liquidity, especially in this industry, can be assumed to be heavily correlated with volume and also being the absolute focus for even some players within the space. I think this is thanks to specific ratings that are all depending on volume. We often in conversations tend to need to explain what liquidity truly is. I think Kevin once, in a very simple way, shared what liquidity is as a definition, and I think it's really easy to interpret it by other people as well. So if you could maybe share some insights on liquidity and also how it's been managed by various players in the traditional industry, right? Because liquidity is not something that's new. It is in a way a definition of an efficient market. So how was it managed in the past? And how will that also be a challenge for the new digital asset space? Because there is quite some mismatch over there as well.
Sure, yes. So, I mean, when you think about it, there are many different definitions that can be provided for what liquidity is. At the end of it, liquidity is going to be the ease for a holder of an asset to basically exchange it for another asset. Very, very bluntly put, it's just how I have an asset or I want to acquire an asset, how easy can I do it? How fast can I do it? And what cost can I do it? So that's liquidity is the ease to exchange a property, basically. So now when you consider it, well, liquidity is definitely at the core of any market. The reason why you start to participate in the market is because you either want to buy or you want to sell. And so the speed at which you will be able to do so and the ease at which you'll be able to do so is a key feature of why you participate in the market. So liquidity is definitely at the core of any market, definitely financial markets, but basically any markets for that matter. And some assets are going to be more liquid, some others are going to be less liquid. But liquidity is definitely at the core on any type of market. Now, when you consider it, what's the role of a liquidity provider, market makers? Well, if you look at you take a basic example of a financial market, you have one participant that comes on the market and wants to sell an asset at a certain price. Well, it only very rarely happens that another participant wants to do the exact opposite transaction at the same price at the same time. It's there's time in the middle. So this is where market maker comes in. So basically, the market maker is going to be acting as a buffer between two parties that want to transact on the same asset, potentially at the same price or a slightly different price, but at different moments in time. And that is really what a market maker does. In bringing liquidity to the market, it allows the market to basically flow in a way that is as efficient as possible by bridging the time gap between participants on the market. This is really the essence of what market making is. So when we talk about liquidity provision, also it's the words are sometimes a bit interchangeable between market making, providing liquidity. Liquidity provision is a broader term to basically help a market be more liquid, more efficient, and market making being one of those services. So this is when you look at Keyrock, what we do. So market making is the core of our business. So we are active on markets, providing both a buy price and a sell price, making sure that there is always another party for that trade that investors want to make. So as you mentioned, there is sometimes a bit of a misinterpretation on what liquidity is and what liquidity provision is. As a service, providing liquidity to the market is not creating volume on the market. That simply does not work like that. And so it's something that's it's a kind of a shortcut that's sometimes taken when we see that the volume is indeed the metrics that is the most often reported about any type of market. But what liquidity provision does is that we make sure that the order book is full, that there are orders both on the buy side and on the sell side at different price levels for potentially important amounts. And of course, the last metric is the spread. So how close the first buy order is from the first sell order. So this is basically we prepare the field for potentially an active market. And of course, if you have a market that is very liquid with a very healthy order book, a tight spread, having volume is going to potentially be a consequence of that. But it's not something on which we as market makers will have a direct impact on. We are there to provide a healthy order book and make sure that if people want to trade on the market, they are able to do so with a spread that is as small as possible and enough outstanding liquidity on both sides of the book so as not to have massive movements in price if there are large transactions. But so at the end of the day, a volume is definitely a potential consequence, because if people want to transact a lot on the market, and that market is liquid in the forms of having a healthy and dense order book, of course volume is going to happen, but it's not the sole metric to consider here when we're talking about providing liquidity and providing market making to a service, clearly.
And what you just said about filling the order book and making sure that there is liquidity on both sides, obviously, and that's maybe an interesting one to tie into how we work with Onchain Custodian, or at least that's the foundation of our partnership. And maybe Alex, you can get a bit deeper in there as well. Is that obviously inventory is needed for that, right? If you look at how we are as a business, we are a service provider. We're not a general partnership with LPs that trade on behalf of especially with the focus of generating alpha. And we are there to provide a service and are more of a technology company that happens to be really good at trading instead of the other way around. Alex, maybe it's interesting for you to chime in on there, because obviously for everything that we need inventory, right? We need the assets to be able to trade those assets, and that's also a possible link that we have with you guys. Is it something that you within the whole ecosystem are looking to expand? How do we fit within the ecosystem?
So I mentioned lending early on. So lending, we can use lending platforms to deploy some of our customers' assets when they want to earn a yield on it. But we can also deploy those assets to market makers like you, for example, when you are in need of liquidity or on the other side of your trades. Another topic that we're working together on is often the customers we're talking to are your potential customers as well, and vice versa. So the exchanges that are interested in custody obviously would potentially be also interested or are generally interested in market making activity to support their business. The same for token projects. And that's really the reason why we started working together, because I'm sure you will agree with that. We noticed that most of the customers we were talking to, you were talking to, and vice versa. So it was making sense to cross-reference the needs of our common customers to one another, and when they decide to work with both of us, offer maybe a discount on the pricing just to attract the interest, and make a nice commercial deal with that is a win-win-win situation. But most importantly, to be able to offer the right services and answer to the needs of our common customers.
I think that's going to be key, right? Because we've spoken, and sorry to interrupt you. Did you want to say something, Kevin?
Yeah, no, just rebounding on what Alex was saying, that for us, when you look at how the market started, the digital asset market in a whole, you see that basically at the beginning, of course, since everything was starting from scratch, you had everybody doing everything, and that a player getting started had to cover every single part of the value chain to bring its service or its product to the market. And that's something that is, of course, very understandable in a market that gets started with some of the basic infrastructure is lacking. So in the same extent, when we Keyrock started providing market making and other liquidity services, depending on which type of market we were working with, whether we were working with a centralized exchange that was doing the custody itself, or with also when we started working with not custodial exchange where we had to do the custody ourselves, well, we had to do some part of the service, such as custody for non-custodial exchange, that is simply not part of our core business. That is simply not our main added value. So I think that's really the base foundation of this partnership, is that it makes complete sense for us to focus on providing liquidity and not on safeguarding the assets that we used to do it. It's simply it's a different business. It's a different competences, different skills, and so hence the foundation of this partnership. I think that it also something like this it raises lots of interesting questions regarding centralization and decentralization, especially in our industry, because at the root of it is a kind of a purpose to decentralize everything. That decentralization is good in and out of itself, which is something I challenge, in that I believe that indeed decentralization can be extremely powerful and extremely useful for some activities, where some others are better kept centralized, or you can have a mix of both depending on your competences and what you like. In the case of this, for example, of custody, in our case, it makes complete sense to work with a partner like Onchain to actually have a custody that is trusted with somebody who's an expert in it and making this whole business. So it's really the foundation of our partnership. Yes.
Initiatives like this, Alex, is also something that is probably also going to be needed. I think a lot of people, when we're talking about custody solutions, say that there is a multitude of different options. It is going to be the collaboration between players like us that is also going to differentiate both of our businesses. That being said, we are part of a very fast evolving environment, a very fast evolving industry. What we're already seeing right now in traditional markets is also maybe another instigator for innovation. Where do you see the biggest opportunities lying ahead for Onchain Custodian, and especially as an opportunity to keep leading the pack when it comes to differentiation and other players?
Sure. I think what we've decided to do from the start is to focus our main activity, our core activity, on custody. I mentioned that before, but also we trying to focus on one specific region called Asia Pacific, which is broad enough to build something meaningful. But I think this geographical focus also helps us better serve the needs of the Asia Pacific customers, in the sense that we know this region as most of our team are from this region. I myself have been here around for 8-9 years now. We understand the specific needs of specific service needs of of our customers in our region. So that's a differentiator. And beyond that, I think in terms of innovation, what I mentioned before is that we will have to quickly evolve into more than custody, and we've decided to do that through partners, through an ecosystem of partners, in a way that the single window access that we want to offer to not only the assets that the customers hold on the blockchains, the various blockchains, but also to services that can help them stake, that can help them lend, that can help invest their tokens into investment products. This single window and this open finance service, as I call them, the more developed they become, the more choice we can offer through our services. With the best curated partners, the best we will be positioned to be different from our competitors. I'm also predicting a day where competitors will work with one another, like in the traditional custody space, where you use a custodian, a sub-custodian, to safekeep assets that you can't do yourself for technical reasons or for compliance reasons or for regulatory reasons. And there will be ultimately a network of custodians like it exists today in the traditional space, with their specialities, either geographical or the type of coins they support, that will build up. I don't think we're there yet. I think it's still too competitive to start those discussions, but we've already started engaging with a few to kind of assess the appetite to collaborate in the future. I think it's in the interest of the industry, in my view. I think it's better to grow the pie before fighting for each pieces of the pie. The pie is still very, very small when you think about it, and I think it's the responsibility of everybody to build that pie. That's the reason why, by the way, Onchain Custodian from the very beginning, and it's also a differentiator in my view, has been actively engaged into community and activities and corporate and industry groups. So we're working at the Global Digital Finance. I'm the co-chair of the Custody Working Group, where all my competitors sits, and we discuss matters of regulation, code of conduct, market practices for custodians. We're also supporting standardization initiatives around how to identify this token, for example, which is today there is no standards for identifying tokens. So there's an ISO working group that I'm convening at ISO level to discuss that topic. And I think those type of collaborations will also make a difference on who will be sustainable long term versus those who will be looking for quick money. And leave, and the three founders will leave with that money and leaving their customers on the side.
I think not only that comment, but also what you said about making the cake bigger for all of us is something that chimes a bit in perfectly on the next question. If you look at making the cake bigger, obviously the market needs to grow as well. If you look at the type of assets that are right now in custodianship, or also that we are trading, the majority of that is the utility token that has seen its boom and hype cycle, boom and bust cycle, end of 2017. But in essence, proved the concept of fundraising through smart contracts, which in the end of the day is a very impressive feat. In 2019 and 2018, maybe we saw the hype cycle of security tokens. For which there are a lot of applications, but the operational feasibility and really how fast it's going to get there is a big question mark still. We've seen the exchange tokens. We are now seeing tokenized commodities. Maybe, and for us, it's going to be essential as well to both, be very complementary in being able to provide the services for these new tokens. So maybe Kevin, what's your vision? What is going to be that new next big thing from the token asset side that will be our maybe first use case of shifting the majority of our operations from currencies and utility tokens to that new asset, and what is needed for it?
Yeah, I think it's a very interesting question, and of course, very broad question. But just something maybe what you said, we've witnessed the cycle for securities token. I think we've barely even witnessed it starting. It's it's in 2018, 2019 it started to be discussed, and of course there are players that are active already. Players like Polymath or Tokeny have been active for a very long time on securities token, and it's been discussed a lot, but it has not been. It hasn't seen any acceleration and any real increase in its use and the usage and the availability of those tokens. The reason for that, I think that the main hurdle that was a bit slower to overcome than what we've seen for utilities token is of course regulation. And at the end of the day, whether when you talk about a securities token, whether it's represented through a decentralized ledger or represented, sorry, I think there was a bit of noise behind me, whether it's represented through a decentralized ledger or represented, in a central depository, at the end of the day, it's a security. So of course, you need to have a regulatory framework that is adapted. And that's something that we only now in March 2020, we're starting to see happening more and more. So, I mean, of course, we're a bit biased in looking mainly what's happening in Europe, given that we're based in Brussels and it's our most active market. But we've seen that the EU has published studies, advocating for the current regulatory framework for securities to be easily adapted to digital securities. So we see that actually, happening more and more. And so I think that what we've seen in 2018, 2019, and the beginning of 2020 was just, the birth of that cycle towards digital securities token. But it's definitely a cycle that is very far from being complete yet. So when I look at the trends and where the potential lies, I mean, when you think about it, tokenization is basically securitization of any type. It's potential securitization on any type of asset. So we had a first use case with ICOs, where in many cases, yes, there was the tokenization of a utility token, which makes a lot of sense to incentivize a network to participate in a product. In some cases of what happened in 2017, it was also simply the tokenization, the securitization of basically a Kickstarter campaign, but of course with some limitation in terms of rights that were attributed to actual investors. And now we see that this proof of concept through ICOs really shows what can be done in securitizing different type of assets. So that's going to be securities, debt, of course. So equity, debt, can be commodities, as you say, real estate. We've seen application in arts as well. I think that the potential is simply endless to consider the existing assets that could be, that are being already traded and already exist in traditional market, and how they could be potentially transferred to another technology, which would potentially make them more efficient, more liquid, more easy to trade, but also in the creation of new types of assets on this new infrastructure. So the point is just that, in the last 2 or 3 years, the innovation on the market has gone a bit faster than the framework around it to make sure that all participants are protected. And we see that this is, and that's mainly with regulatory framework is something that we see is gradually catching up and making sure that these applications can actually be put together. The last point to consider is also the technical debt. I mean, the traditional markets have existed for some time. There's a whole infrastructure that is in place. Here we're talking about switching to something new that require new players and requires a lot of investment on the technical side of things. And for these investments to be made, of course, we need to make sure that the benefit of the switch is higher than the costs that are incurred by doing it. And this is still something that is, that I am, of course, extremely convinced of, but some might say I'm a little bit biased, but I think the business case is clearly there, and we see that incumbent players on the market are starting to see it as well, and be more and more active in the switch. So, I mean, the potential for this is really, I think, a complete replacement of the traditional financial infrastructure with this new infrastructure that promises to be potentially a lot more efficient and a lot more and a lot more beneficial for all parties involved.
You were talking about tokenized art, which is a very, very interesting use case. What is very interesting is that a part of the group and one of the attendees, Martin, is working on such a project, who also just asked the question regarding how such thing could be tokenized, or security tokenization can be stored. So I think that's a question for later on. But it's definitely something that we also see as an opportunity and an application in the future ahead. Obviously, regulation is going to be key. Having the right infrastructure, the right regulatory clarity to build out our companies as well. This is going to be the last question that we cover before heading into the Q&A, because we've got quite some questions, which is great. All right, regulation is key, and especially in such a disruptive industry where regulation years ago was frowned upon, now is very welcome and is essential for growth. What you don't maybe know, guys, but Alex is from Belgium as well. It feels like a little Belgium connection. He moved to Singapore, I think about 10 years ago. So maybe let's combine these two questions on how do you see the difference between Europe and Asia? First of all, as a foundation to build out your business, and also vice versa, Kevin, on how do you perceive, Europe and especially the capital of Europe, Brussels, to be the case, and also where do you see the biggest and most interesting trends from a regulatory perspective to accommodate that business development? Maybe Alex, so you can share first your Asia experience.
Sure. So the beauty of Asia is that it doesn't have that much legacy in a way, or is less legacy both in terms of regulation but also technology compared to Europe. So it's easier, I would say, for both regulators and companies to leapfrog, to try new type of infrastructures, to try blockchain, to try digital assets, in other words. The challenge, nevertheless, is that it's very fragmented. So every country has its regulators, its different laws and regulations and licensing scheme for our industry, or for all industry. And in the digital asset space, the challenge is that it's so early stage that everybody's is progressing a little bit with their own agenda. Korea with its agenda, Japan with its agenda, Singapore with its agenda. So for a company like us trying to operate across the region, we often have to assume that being in Singapore, yes, we can probably service customers in Japan as long as this and this and that. Or we can service customers in Malaysia as long as they maybe not they a qualified investor, for example, and so on and so forth. So we need to be very certain, or at least have enough level of certainty when we engage or when we onboard a customer, that we won't be in trouble in the near future because of a change of regulation, or because of a regulation we overlooked, or a situation that is complicated in terms of the type of investor that we would be working with.
I mean, what we see in our discussions here with the regulators, we, of course, in Europe, so there's some kind of harmonization between regulators in the Eurozone, not completely, because each is going to be transposing EU directives into local laws at different speed, and sometimes going further than what the EU prescribes. So there's not fully aligned. But so in that scope, we've been speaking with lots of with many different regulators, and I mean, we're very happy to see that it is moving forward, because at the end of the day, what regulation brings is that, yes, it can bring some hurdles and some higher requirements, which I think at the end of the day are good, but also it provides clarity, and clarity is definitely what you need if you want to build a successful business. So we welcome those regulatory advances with open arms, and I'm very happy to be in a position where we can discuss with the regulators to better understand their position, making sure that they understand ours, and really build something in a collaborative spirit. So we've seen tremendous evolution in Europe in the recent months. I think in most recent weeks, Germany has been extremely forward-looking. For example, with the BaFin recognizing Bitcoin as a financial instrument, issuing guidelines on how to provide custody, and so. I think that tens of traditional banks have got in touch with the BaFin, so the German financial regulator, in order to start working with digital assets and with Bitcoin. So there's definitely a lot of advances, but that a lot of work that remains to be done, because you can start thinking about, okay, what are the processes I'm going to be putting in place to provide market making or other liquidity services on regulated digital assets. You can think about it, but then it doesn't exist yet. I mean, there are no real secondary markets that are, that are significant enough yet to really be active on in regards to STOs. So it's quite tough to have that discussion about being very forward-looking to, all right, this process is going to take a year. The market is going to take still some months to be really a bit more mainstream and really big enough to be active on. So, let's project ourselves a bit forward, but at the same time, you need to precisely describe the process you're going to put in place and know exactly which part of your business is going to come from regulated or unregulated assets. So there are, of course, some challenges, but if you compare to, the discussions we have now to what we've seen, a couple of years back when we got started, clearly the evolution is extremely positive, and I think that across the board there's a strong realization from regulatory stakeholders of all the benefits that digital assets can bring to financial markets. So definitely, it's moving forward in the right direction.
All right. Keeping the time in mind, one last question, which is for both Kevin and Alex. We're currently going through the COVID-19 challenge, which is on a global scale, obviously unprecedented times. How are both companies managing? Do we see that COVID-19 has maybe less impact on the digital asset space than maybe other industries, or do you see it be comparable? How is everything going?
I'll start. So I guess there are positives and negatives, as always, in a crisis, opportunities and issues. On the positive is that we've been able to operate with no glitches, no issues, by the simple fact that we are operating a platform that is quite modern in terms of age of creation, and we put the right BCP in place to ensure that if those type of issues would be happening, we would be able to operate even if we're not able to enter our office. The fact that we are in Singapore again was really positive for us in the sense that we've been able to prepare, as the government has been very transparent about how they would evolve progressively the what they call the circuit breaker, or what you call the confinement in Europe, meaning ensuring that as less worker as possible go to the office, and we can see that compared to other financial institutions like banks, for example, that has been a struggle for them. I have a friend who works for a Japanese bank I will not mention. They still have not managed to send 75% of their staff at home because of the lack of digital infrastructure they have in place for their employees to be able to work from home. So that's the positive. The other positive as well is that as everybody's working from home, it's easier to get hold of decision makers for signing contracts and pitching ideas and pitching projects and pitching our products. So on the sales side, it hasn't impacted us too much. Of course, some type of customers are more complicated to reach out via email and social media than others, but hopefully we'll be able to continue. I guess the negative is the fact that people don't really know where they're going, both on the customer side, so they could hold some decisions waiting for better time to take it, or investment. So we're currently funding, going through a round of funding. So that's also slowing down on our side. The good news is that we started way early, and we don't have to worry about it. But we know that it's going to be more of a struggle, obviously, in the current situation. But everybody's safe at the office, which is what matters the most at the end of the day, and in our families as well.
Yeah, I think the take on our side is going to be, it's very, very similar indeed. We're a young company, so in terms of technology, we don't have very large, legacy infrastructure that we need to adapt to be able to work from home. Luckily, same thing. The entire company is safe and healthy, which is the best. The main change is that what you see here has been my world for the last 2 weeks, but for the rest, as a company, it's doing well. I mean, the impact of digital assets, well, on the market as a whole, is going to be the same thing than what you would see on financial markets traditionally. The business at the end of the day, technologies are different, infrastructure are different, but the business is very much the same. So the considerations are the same as well. So yes, I think that everything is a bit slowing down. We see that some of our clients might be a bit more impacted, of course, because yes, they they issued assets, but they have a business behind it that might be impacted, of course, by the measures, and we're there to support them and hope that they will go through it and come out of it stronger. But yeah, on that we can just be thankful to be safe and healthy, and hope that this all goes away as fast as possible.
All right, guys, we are 9 minutes over time, but hopefully, based on the people that stayed, it was interesting, so that's good. If there's any questions, please do ask them. Also, please feel free to add us on LinkedIn or any other type of social media. We are here to help and answer any type of questions you might have. I hope that it's now a bit more clear on what custody and liquidity solutions entail, and you've learned also a bit more about our companies. Thanks again for joining, and if there's any questions right now, do please shoot.
Thank you, guys.
Thanks.
Thank you for attending.